an insane amount of opportunity in the marketplace, and it's choosing wisely, but I wouldn't be choosing widely. I'd be choosing a very narrow focus. For me, I kind of told you what my three are that I'm looking at. It's fixed income, mortgage backed on that side. I really like US mortgages right now. I really like the residential market. It's, to me, head and shoulders above everything else. If you look at, again, risk adjusted returns, when I'm looking for upside, I'm looking at a 5-year, 10-year play on industrial, particularly industrial warehouses.
Another week, another episode with a stud, someone who's got a lot of takes, a lot of opinions, and an incredible social media presence. This is someone I've known for a couple years now. Nick D'Angelo, president of Saint Investment. How are you today, my friend?
Craig, man, we've gotten to hang out in a couple countries, a few states. We've shared some stages even. So great to catch up with you. I'm doing great. It's been a good week at Saint, and I'm excited to jump in today.
Yeah, well, I'm very thrilled to talk about a couple things with you. Of course, you follow the market religiously. You always have takes, posts, really good content you're posting out there, good information. And then you are really knowledgeable in debt as well as industrial real estate. So we're going to dive into that. But before we get there, how did you get to where you are today? You know, what did you do right after college? Did you go to college? And what was the trajectory to get to where you are today, where you're, the president of such a great company and founder?
So I always had the mentality to be around the best people, the biggest people doing the biggest things. I always kind of, I guess, had a chip on my shoulder in that way, wanting to be around absolute 10 out of 10 people, even knowing that at times I couldn't add the same value. So I was always trying to add that value. I started off with a couple small family offices. It was the wake of the 2008 crisis. I knew that even if they were having hard times, which most of the industry was, that I could learn generations of strategies and inputs and value from them. So I did whatever I could to get close. I offered to work for free. The first CEO kind of laughed and said, "I can't afford you," even though, at the free level. I took that personally, but I negotiated a job by bringing him a list of 500 names of people that wanted to buy real estate in the greatest financial crisis since the Great Depression. And I said, "Look, I understand that you're like letting go of teams right now. You're cutting people off, but these 500 people want to buy today. So if you guys transact on even a small number of these and your brokerage makes money on this, it should cover what I'm worth." He liked that initiative. We worked together for years, and I learned an infinite amount more than that free initial paycheck would have, been in my pocket. And he's still a dear friend today, and got to do that a second family office. And then since then, not long after that, I was buying up to $10 million a week using cashier's checks in my jacket pocket at the courthouse steps, buying foreclosures, commercial foreclosures, complex real estate deals that would have been far out of my reach, but I was around really amazing people. So those were my early days. And I was blessed to have gone bigger than I should have, probably by most accounts.
Well, what I love about that as well is well calculated and well timed out risks and going kind of all in at the right time, and really just having a don't take no for an answer mentality, which is what you implemented there. And of course, that risk and that tenacious attitude brought you where you are today, living in beautiful Southern California, the OC area. So it makes sense as to why you live the lifestyle that you do and are doing how well you are. So that's amazing to hear that. And we'll get into what you're kind of seeing right now, which is maybe cautionary tales of what we saw during that time. But tell us, you, of course, went from doing that. Were you doing anything else before real estate, or just got straight into real estate with the family offices and then you started Saint Investment? How long ago did that found, and what's kind of the story behind that?
Yeah, I saw people that were wildly successful, and I also understood the time and the focus investment that they made early on. So I transitioned pretty heavily outside of college to the focus was that I knew most of my 20s would basically be traded for 24/7 work. And the honest to God truth was that was most of my 20s. I was pretty much dead on that. and I ran a small business at night trying to pay the bills. I started an ATM company that, was my first six-figure endeavor as an entrepreneur, and that paid the bills while I was working for free for really kind of the long-term play, learning from these real estate greats. Over the years, we've built a few companies, sold a few companies and an exit, and really the focus was always to be reinvesting into real estate over the long term. So the biggest transition was we woke up at a period of time going on buying sprees, buying everything that was these ridiculous priced deals, primarily very distressed assets. We had great relationships with banks. We were helping them clean up their books. We knew all the criers at all the trustee sales, all the mortgage, foreclosure sales. And what happened was we bought so many deals at such great discounts with such great returns that we actually overbought. So the biggest transition was starting Saint was working with these great groups and these great investors that were incredible buyers, but overbought. And so I started Saint as an asset manager. So we built out the asset management part first. With Saint, we already had the acquisitions piece. We already had the acquisition systems. And then the biggest transition was bringing in outside investors and starting to raise capital and kind of bring in what we had done very successfully with some amazing investors to more the retail investor and the investors that didn't have access to these kinds of deals beforehand. So that's a little bit about that middle piece and where we're at today.
Amazing. Thank you. And then speaking of where we're at today, let's talk about some market insights that you're seeing. What is going on right now? There's obviously a lot of uncertainty, a looming threat of a recession. It seems like we personally felt like we've been in one, because I think everyone can look around and acknowledge that their dollar is just really not doing what it used to do. Things are just more expensive. So, obviously in the private markets, there's been a recession. A lot of companies have laid people off. The only hirer, go figure, is the government right now. So what the heck are you saying?
Yeah, I geek out. Like you said, I geek out on economics. I know you do too. We've had a lot of really high-end conversations. Here's some data that we literally pulled in the last 5 days, okay? 59% of Americans believe we're in a recession right this second, okay? Now, let me just preface by saying I'm a political independent, okay? So I'm just calling balls and strikes, all right? 59% of Americans believe we're in a recession right now. That's where, regardless of whatever the government does to reclassify the term recession, 59, nearly two-thirds of Americans believe we're in a recession today. 39% of American families right now are month to month worried about being able to pay their bills, like not being able to pay their bills consistently. To give you a backdrop, in the global financial crisis, which I came up during, 37% was the number of families that couldn't pay their bills month to month. So right now, we are in a worse position. We are in a worse position for more families than we were in the Great Recession. That's the backdrop of what we're dealing with today. Over half of families in the U.S. are making significant cuts throughout their budgets in order to make those bills. So that's the backdrop of what we're doing. We've seen in the last few weeks, stocks get crushed by nearly 10%, right? We've seen huge publications come out basically saying, hey, we don't have faith in the stock market right now. You look at Investor Business Daily, they're saying that you should cut stock exposure by 20 to 40%. Right? And then you have a bunch of places saying they don't endorse buying any stocks at all whatsoever. It's a hold period for the public markets. All that's the backdrop of what we're seeing on kind of like the national scale. That said, yeah, I'm kind of a contrarian. My bones were made on the acquisition side in some of the worst markets we've ever had. So I think it's a fantastic time to be investing.
If you're an investor, this is sweet. This is like, open season, carte blanche, really, you could fall out of a boat and hit water every single time almost right now, right? Like you almost can't miss when there's economic turbulence. And that could be if the stock market drops, you could get out from the S&P 500. If, right now there's obviously debt issues, which we'll get into, you can make money there. So when the market gets bad, it's really tough if you're living paycheck to paycheck, but if you're making good money and you've got capital to place, it's the best time of your life.
And that's That's one of the biggest, predictions, if you want to call it that, something that we see coming up on our side with our research is that there's so much opportunity right now, but the opportunity for missteps and the ways to do it wrong are many. There's many risks in the market, but at the same time, huge opportunities. So we lean into a few asset classes. There's a few that we are over targeting right now. The majority we are saying absolutely not. We're also not targeting most markets. So it's about laser focus to us. It's about knowing exactly what we're looking for, and we're finding good deals and good opportunities in the midst of
Right. So before we get into the strategies and where you're placing money, what you're really looking forward to, I want to unpack a couple of the incredible statistics that you just laid out for us to set the table there. So you mentioned that 39% of folks are living paycheck to paycheck right now in this country. So basically a fraction above, a third of Americans. So 1 in 3 people you see is experiencing that. Tough. And then you also mentioned as well that 59%, roughly 60% people think we're in a recession. So who the heck are the people that don't think we're in a recession? Are they really just that rich? And I guess there obviously is a large cohort. I mean, the biggest population growth of the people in this nation, the wealthiest people, are boomers, right? The boomers who I know you target, we love the boomers. They're great investors of ours, but, they bought real estate in California when you could buy it for a bag of potatoes. So inevitably getting rich was a lot easier when that was possible. Last I checked, where you live in the OC Newport Beach area isn't really where it was priced in the 60s, 70s, and 80s. I could be wrong. Maybe I need to get my commas checked and my eyes checked. But with that said, right, 60% of people essentially, think we're in a recession. Who are those 60% that think we are? And then if you know that, and who are the 40% that are not, that need to really look at a chart? Because I guess, stocks really are that high right now. Real estate valuations are very high. Homes are really high. So that's really hasn't been affected yet. But it's funny, David Sachs mentioned, on All In podcast about couple weeks ago, when this airs, that we don't necessarily need to have prices drop for us to be in a recession, which really stuck out to me. So with all that said, we'd love for you to unpack that now.
Yeah, and that's very interesting that not needing prices to drop does not mean a recession. There's also people that hold the belief we're in a crash on the upward scale. So we're crashing up, right? That's an interesting methodology. I don't necessarily fully buy into that, but very smart people have a lot of smart takes on how we should be unpacking the discussion of a recession. Here's my take, okay? I think the 40%, the 41% of people that aren't feeling like we're in a recession are either splitting hairs on exact definitions. Again, the government changed the definition. That's one.
They moved the goalposts on us. And how long ago did they move the goalposts? Because that's very interesting you say that. No one has said this on the show yet, that specific thing. Because I recall that you're like, well, it's not this and that. It's like you literally just changed the definition. It's like I could change... Well, I'm not going to get into it, but yes, they changed the definition of it. So with that said, what the heck was that? So please unpack.
Yeah. And so, we could go all the way back and say that, when this current administration entered office, inflation was at 1.4%, right? That's just a date on a map. That's not political. You fast forward about 18 months, middle of 2022, inflation was at 9.1%. The highest we've had in 4 decades. At that point, we're still remembering when Janet Yellen was telling us that inflation was transitory. You remember this? Mm-hmm. And then so they changed the definition of transitory. Also, we won't go into all the government definition changes. But most importantly today, to answer your question, who are the 41% that don't think it's a recession? I really believe it's exactly what you're saying, Craig, I think it's the people that are very insulated in non-turbulent assets, things that are stabilized, things that are long-term, that if you look at a trajectory, either have ridiculous track records in the last decades and likely have a very insulated future in the next 10 to 20 years. So home ownership, I think that's a huge piece of it. Disproportionately owned by the boomers. Like you said, I think that number is about 43% of homes in the U.S. are in boomer hands. So
they probably have no mortgage anymore. They have a HELOC here and there, but the likelihood is that most people, who are 60 plus, who've done well, don't have a mortgage on their house. They own it for next to nothing, and they can live a really nice life. And their property taxes are probably not too crazy. I mean, obviously, Florida and New York and Texas, it gets assessed every single year. But a place like California, it gets locked in. You don't really, it doesn't go up. So you're really not affected if some of those costs that you're in don't really change and you don't really have any payment there.
So that's what I would say the 41% is. I haven't dug into that. We just pulled the statistic, so I haven't spliced and diced this to the highest degree. But that would be my gut feeling is individuals that aren't feeling the recession are people in long-term assets, long-term cash flow, stabilized, their investments are carrying them. They're not feeling like, hey, I need to cut back when I go and buy groceries. They're saying, my life's not really changed. How could we be in a recession? My life's the same, right? My net worth's only going up. So that's my thought. That's what I would bet the 41% are seeing that is not feeling we're in a recession.
Right. So with that said, when the folks there before from the data, you experienced at 37%, were the people that, I guess, before everything kind of changed and crashed, I mean, they probably changed their tune really quickly because it was a very quick plummet once, the kind of CDOs and whatnot kind of came to fruition and that got realized and we got mark to market. Of course, Lehman and other people went down. That was obviously, okay, we're clearly in a recession or some sort of crisis, if you will. And naturally, when, most of America's housing price goes from 100 to 50% of value and your stocks also basically plummet, if you had $1 in the market, turn into 50 to 60 cents, that's, problematic. It's very clear that's a recession. But, as we mentioned, prices are high here. So, when did those individuals, I guess, before realize that, or the month-to-month people, really struggle more? I guess, what is going on outside of that? What does this mean moving forward?
Yeah, and I think you nailed it. Global financial crisis, the GFC, there were the biggest assets that people ever own as their home, statistically throughout the U.S. on average. With that, taking hits of 40% or so, I mean, those are terrifying things. Their retirement accounts taking hits of 30s, 40%. Those are very obvious. They're staring at you in the face. What's more insidious and less understood is I think where we're at today, which is this creeping inflation and these long-term upward pressures on pricing that we're dealing with. My bet on inflation, just to give you like what we're seeing on the data, I think we're dealing with this for over 10 more years, at least, maybe 20. But definitely 10 plus is what we're expecting on that side. And I'm not saying necessarily higher rates. I'm saying upward pressure on the inflation pressures. I think with the baby boomers stepping out of the market and taking their capital with them, so they're not as yield sensitive, they're not as yield hungry on their capital, I think we're looking at that being a huge shift in the market. I think our employment structure with baby boomers retiring, the largest generation, the wealthiest generation leaving the workforce, I think you have Gen Z stepping in, which is one of the smaller generations in U.S. history. And you have a lot of shifting going on in that period of time over the next decade. So the question is, what do you do with that, right? If you're an investor, if you want to be strategic about economic data that you're seeing, right? On the flip side of that, we're still what we're seeing on the economic side at Saint. I'm not betting on a crash. I'm not betting on a bloodbath like the post-2008 era. I'm betting on more of a soft landing, like some ongoing pain, maybe, more close to a death by 1,000 cuts than, a axe to the head, right? Like 2008 was, where we had the big five banks. Are they going to fail? Government bailouts all over the place. It was very loud in 2008. I think it's much more quiet today, but still more painful with the inflation pressures.
Yeah, so kind of what I'm thinking here, and I'm really grateful for my residential real estate acumen and background, because let's just kind of set the table here. The massive issue that a lot of people experience in the GFC was effectively, the mortgages, the pricing. People had ARMs, adjustable rate mortgages, right? Well, people now rarely have ARMs or even short-term debt. There's nothing better than a 30-year debt note on a property. It really is the most accretive strategy possible. If you call it commercial real estate on a 10-year note, that's safe, but nothing is safer than a 30-year time horizon, because I can guarantee, and I don't like to use the G word, but I can guarantee if you buy a house today, in 30 years from now, it will be more expensive, So it's hard to lose on that debt instrument there. But what we're going on and experiencing right now is capital being evaporated because debt has changed, and you've got a large swath of deals that are owned by institutions, syndicators, you name it, that are on bridge debt or adjustable mortgage, floating rate debt, which, well, as it floats up right now, there's problems because now with that becoming more expensive, labor becoming more expensive, property taxes higher, insurance higher, you name it. These properties are really struggling to, really make sense in a lot of cases. That's creating a lot of equity evaporation. So I think money is going to be lost there. But it's very interesting too because we've got AI coming around, which is very deflationary, and will also make us a lot more productive. So I kind of agree. I don't think it's going to be really nasty. I don't think it's going to be great. But at the end of the day, you're looking around, and I'm sure you're struggling to find employees for your jobs and stuff that are good quality people that are kind of more blue collar folk. It's really a white collar recession right now, which is interesting.
I absolutely agree. I think we all are looking for great tradesmen right now. I think there's a massive shortage of that. But I think you hit the nail on the head with your residential real estate background. You're really understanding the depths of what this looks like. So I believe the last statistic I was just looking and digging into on this is something like 98% of mortgages in the US now are fixed rate, right? And the majority of those are 30 years. This is not a worldwide norm.
And right? Also,
the rest of the world doesn't do it this way. So that's unique.
I'm also very confident, Nick, as well, that within our lifetime, I don't know when, to create affordability, we're going to have a 40-year debt note as well, too, which you're just going to refinance that, but it'll just be a way and a means to kind of lower the monthly payment so everyone can make it more affordable. But what's going to happen is it's going to flood people into the market and make things more expensive, naturally, right? But that is going to come. Make no mistake, in my opinion, there will be a 40-year note, maybe for first-time home buyers or for people who make lower income to make that there. And I don't disagree with that. I just think it's going to happen. So just, hey, how can we profit from that? It's not my job as, us being independents, right? To comment on that, speculate that, just how can we profit? How can we set up our investors to do well? And that's what the conversation here is about. But it is fascinating to think that is occurring in real time. And, the places where there's a lot of foreclosures happening right now, it's in places that are like Texas, actually, for homes, and Florida. What do those two places have in common? Readjusted property taxes with the appreciation of the market and insurance costs being very expensive. If you bought a house thinking payments can be X, let's say you bought a house for $500,000 as a round number, and it's now worth $650,000. Okay, well now your property taxes are based on there, but if you bought in 2020, replacement cost is here, now it's here. Okay, that's what insurance is based on, and also weather risk. Climate change is that they factored into the underwriting of insurance. You can have your opinion on that or not. That's just a reality with climate change affecting this in coastal markets. Florida's all a tier 1 risk. That's making a lot more foreclosures and inventory happen because people can't afford that, which goes back to the inflationary conversation.
Yeah, and I think those are really interesting markets. I think I forgot the exact stat. I geek out on stats, obviously, but it's something like record uninsured homes in Florida for that reason that insurance has just gotten so 5x plus.
Well, there's carriers leaving California right now, which you live in. Yeah, exactly. State Farm is leaving. Guys, that's a massive issue. My grandparents have a house in Oakland Hills, and they can't really get a fire quote, which is awful, right? So that's a problem.
Yep. And so if you think about the boomer demographic, right? The boomer generation, again, largest generation, wealthiest generation, also moving to the retirement stage. And they're seeing this turbulence in all these different areas. We're blessed. We've worked with, an abundance of boomers. We're disproportionately working with the boomer generation. What we saw over and over and over again was our investor base was saying, this is all too much. This is all crazy. We performed great at Saint. I think our last 7 exits were over 35 IRR, and people didn't want those. I was super proud of it, but they didn't even want those returns. We've never not paid an investor back. We've never missed a distribution, and they still were saying, Nick, we want to shift to something that's more stabilized, more secure, that we don't have to worry about, something that we could, look at for 10 to 20 years. So that's why our focus is residential today. For all those reasons that you just said, is it's such an overly stabilized market compared to so many with 30-year mortgages and fixed rates during that time. People can bunk in. I love that market right now for everything you just said.
Without a doubt. Well, let's get right into it. So you have 2 strategies, industrial and debt. whatever you want to start with, you kind of led into the debt and what people are looking for right now. So you dive in accordingly, tell us why you love those products, what's so attractive. And it's kind of funny as a side note, this really is fate, because I told you prior to going live here that I've become fascinated recently with debt investing. So I'm sure we're going to learn all the reasons more, and I look forward to hearing with you right now.
Yeah, I'll give you the background. And our background was we worked in about 7 different asset classes, right? Just over the years, our buy box was deep discounts. That was the qualifying factor, was, are they a deep enough discount? And after a period of time, we made a lot of money. We had some great deals, but we figured we don't like most asset classes. We were very clearly focused on buying fair deals at great prices rather than great deals at fair prices, right? And so it's that Warren Buffett quote that is burned into my brain by getting hit over the head with it. So now we're like, at that period of time, we said, what do we want to focus on and why? And we gravitated towards industrial because, many reasons. The leasing is, national credit, multinational credit. We're dealing with 9-figure companies. We're dealing with amazing construction, etc. And then we said, well, what does the future look like for industrial? And so what we see in the US for industrial is that the next decade plus is such a bright, shining future, with things like, unfortunately, China's having major disruptions on their labor costs, their own economic stability, their demographic stability, huge questions that are driving costs up substantially. And then we have the geopolitical tensions. So we're seeing a nearshoring massively, whether that's manufacturing, bringing back that into the US, or nearshoring where Mexico's absorbing a lot of the manufacturing. I think it's an amazing shift to North American economies. So over the next 10 years, we see a shining star in industrial, and we'll be back in that market. The issue where we're at today, like I mentioned, is we had too many investors that were saying we're looking for something that's more stabilized, that's more fixed income side. So we looked at our portfolio, and after buying all these, distressed assets over the years, we also had a lot of mortgages that we were purchasing, just going, I don't know. This is a discount here. It's a stabilized return. It does round out all these deep discounts all these distressed assets we're buying. We get these kind of like fixed returns. So I started buying more of them. We started buying more of them as a group. And so when we started getting the questions of, hey, how can we just have a fixed return that pays out monthly, that has a lot more flexibility? It was a no-brainer. So we leaned in and started the Saint Income and Growth Fund, which is backed by over 500 mortgages today, and vast majority single family, vast majority in that long-term 20, 30 years left on the mortgage notes. And that's what we're leaning into as our number one focus today, and our kind of shining star of what our offering is to our investor base.
Amazing. So let's dive into, where these properties are located, how the underwriting process works. So there's a lot we to go through here. Are these subprime mortgages? How do you find these? Are these normal Freddie Mae, Fannie Mac loans? Are these non-QM, non-qualified mortgages for kind of people with unique income situations? So let's just talk about the product itself. So, how do you bundle these together to invest in them? Are you personally looking through the financials here? Do you have a team doing that? I'm fascinated by all this. Let's get into it.
Yeah, absolutely. So we'll talk buy box to give you an idea. We'll set the table like you said. Buy box is interesting because in the mortgage space and the debt space, there's so many preferences. Okay, there's so many preferences. It's a niche of a niche of a niche of real estate. Most people don't understand it at a high level, and it's a really small world because of that. So what we focus on, again, it's a fixed income fund. We pay 12 to 14% returns on the high end. So we have to look at opportunities that will pay that over an extended period of time. So the short-term stuff is not really our focus, and then the foreclosure stuff is not really our focus, right? It gets thrown in there, stuff where we may have to go through a foreclosure, but it's certainly not our preference, because then it's short-term and we got the money back and we got to go through another cash conversion cycle. So what we're really looking for are deals where the homeowners are occupying the house, so owner occupied, and they want to stay, right? So there's a good ability to navigate and renegotiate the loan, modify the loan to what they're looking for. And we're looking for suburban markets. So when you go overly urban, what we found was that the pricing was just too out of whack. It was too easily swayed by things like, you look at Dallas's new inventory of multifamily, right? 2023, huge, which is amazing for Dallas, right? You look at California with rent controls, doesn't have that type of coming to market, inventory. But the urban markets for single family mortgages were not in our buy box for those reasons. Huge sways by developers and et cetera. On the flip side, you have on the flip side, you have rural, right? It's the middle of nowhere. You might have a farm, you might have an avocado farm or something. It's just niche, and it's local. It's very local and very complicated because of how many acres, how many things like that. So we just look at suburban America, right? We're looking at suburbs of good markets that are ideally growing. We're looking at cookie cutter deals, though ideally white picket fence, 3-bed, 2-bath.
Yeah, you want like a track home. You want to have a kind of a house that's got a laundry list of comp sets for you to pull from. Comp sets is comparable sales for those who don't know. Throw some jargon to you, some comp sets to help you underwrite the deal to make sure that you're getting this at a good basis so the debt actually makes sense for you to accrue the paper on, right? So those are things you look for. And to your point, if you go too suburban, it's tough. You go too urban, there's a lot more volatility. There's a lot more supply coming online. So those factors there is super important. So with that said, where are these loans predominantly located? Are they in California, as you mentioned? Are they all throughout the country? How do you identify those opportunities?
So we lean more into the buy box that I just said rather than any particular specific states. So we're in about 21 states right now. That ebbs and flows. Maybe we buy or sell or, new deals, et cetera. But that will probably grow over time. There's some states that are just too dang difficult. So they're lower on the preference list, right? You look at sometimes New York can be a little difficult on the mortgage market, or Ohio, or even California, my backyard. But those are also markets with really good suburban markets too. So those are all balancing factors that we put into kind of our pricing on those pools. We buy in pools, sometimes with partners, sometimes with operating partners, right? But we buy in pools of loans, sometimes ranging from a handful. We recently partnered on a transaction that was over 115 loans. So pretty wide range, but it's more about the pricing. My background buying so many distressed assets, primarily commercial with a lot of zeros. I was a young guy. I stuck out like a sore thumb in all the rooms that I was in working through these. So it was easy to be like, oh, that guy, buys this and buys that. I built relationships with CEOs of banks and trade desks of banks and people that I still talk to today. Hey, what's on your books? What are you trying to get rid of? What's this look like? Hey, what are you trying to clean up? Because most banks are in a tough position. They got the comptroller of currencies over their shoulder. They have more regulation than they've ever had before. They have many concerns. And really, their freaking business model is origination, right? What they want to do is create more loans. So when they have a pool of 10,000 loans that are pristine, sterling, government regulation, meeting all the bars for all that, or government backed in some cases, all that, and then some guys aren't paying, right? Just pull them off to the side, put them on the naughty list, put them on the non-performing list, and just sell those other 10,000 in a bulk sale, right? So banks were
basically it de-risk it. So they want to get into, so we understand this real quick.
Yeah.
They want to originate more loans because, of course, a loan origination fee. They're not cheap. And then if you buy down points, you pay for this, pay for that, you're getting massive amounts of dollars in revenue there, which they're just going to put that off their books regardless. And they do it at a wholesale price. You think about Chase or, US Bank, which, by the way, if you're looking for a jumbo mortgage, US Bank is always the most competitive, funny enough. If you're looking for Chase, whatever, if you want a conforming, jumbo, you name it, they've got that book there. They have such a line of credit, so much people banking with them with their fractional banking. They want to create these fees. They want to generate revenue, and then basically sell it off to agencies, Freddie Mae, Fannie Mac, government bonds and stuff. And then there's this pool of loans over here that you're alluding to that aren't really performing. Maybe they're late with the payment here, but they're good assets. They put them over here, and folks like yourself buy them. Am I understanding that correctly?
That's the simplified best version. I didn't want to over inside baseball it, but that's it. That's exactly it.
Perfect.
Yeah. And
awesome.
go ahead, jump in.
No, you go on. Sorry.
No, so it's So long story short is they have these non-performing, semi-performing, rolling balances, whatever you want to call them, scratch and dent. There's all kinds of reasons that these loans go into this bucket of non-performing as the blanket term. So what we look for are opportunities where someone's in the home, families are in the home, they want to stay. We have minimum requirements we typically look at for equity because we want them very motivated to work with us. So our equity requirements are usually in the range of, I think our average is around 39% equity, although we've seen more deals lately in the mid 40% of equity, obviously with the huge increase in home values, right? So we're very well insulated. For the market to be, for us to be in a bad position in the market, we see it as a 40 plus 45% crash in home values. But with boomers consistently looking, and again, own 43% of the market, plus government debts around 20%, right? So you're looking at almost 2/3 of the market that doesn't look like it's going anywhere for nearly 2 decades. We love that degree of insulation. We love that degree of stability. And if we can get a discount, then that's even better, right? So those are where we converge on what we're best at. We're good at acquisitions. We're good at structuring something longer term like that. That's what we're looking for, and that's what our investors were kind of looking for.
So you find these kind of assets, you find these loans that are, get you comfortable. They're not comfortable, but you get comfortable, one metric or another, and you bundle those together, and then you have investors who basically invest into that pool. Am I understanding that correctly?
Exactly. What's
the return profile of something like this? How does that work in structure, typically speaking?
So it's a blended, it has to be a blended return profile. Some are long-term workouts, some are very short, quick, and easy, right? But if you talk blended portfolio returns, we're usually looking for a yield hurdle around that 18%. Right? That gives us insulation because, we pay on our top end 12 to 14% to investors. It gives us a nice chunk of any market fluctuation on things. It gives us enough time on deals that if, a bulk of loans takes longer or there's fluctuations with the interest rate markets that we can absorb those pretty quickly. And so that's kind of our return profile. We're looking for a yield hurdle of north of 18%.
And that's just straight cash flow. You don't really get equity in this, right? It's more of just a dividend investment. Is that correct?
It's structured very similarly. The equity component is not there. And again, our investors, we're not looking for that. We're like, guys, remember, hey, there's these opportunities. There's not really a tax benefit component. So this is for a high net worth investor or an investor that's, we see a lot of people with businesses that are very, seasonal or very ups and downs. They just want to balance out their freaking cash flow. Right? Their portfolio cash flow. Because you look at stocks, sure, you can get some dividends, right? But it's really mostly an appreciation play. The biggest returns you're going to get from the equities markets are, on the appreciation side, choosing well. That's tough when there's a lower cash flow component to it. So we see a lot of people balance out their equity holdings with something that's more of a cash flow play. So those are a couple case studies.
That makes a lot of sense. And with that said as well, I just have to ask, begs the question, what's your downside and risk as an investor for something like this? Because obviously numbers like that jump off the screen. We're talking about doubling what the typical market beta is from a return. So how do you, the upside is, very clear, best base case or solid base case is that, 15% plus range. But what is, it going south or, I guess potential 20% market correction of, the housing market do for, this type of theoretical investment structure?
So that's the big question on our side going into this model as well. It was, hey, our investors, again, are mostly boomer demographic. They're looking for what if stuff hits the fan, because they don't have another dance in the workplace, in the net worth game, in the cash flow game, as far as their career goes. So that's why we chose this asset class, is it was the most insulated that we found. So here's what the worst case scenario would look like, right? Is that the residential real estate market in the U.S. drops over 45%. That's one. And again, for all the reasons we've already talked about, the likelihood of that is extremely unlikely.
That would be a black swan event where you're really more worried about everything else going on, not just that itself. Let's just put it that way. And that's
my point, is if really the perfect storm happened, we're talking about things like Federal Reserve collapse, currency collapse, banking collapse before most of the things.
Well, I always laugh too. It's like, well, if you think that's the case, then you should invest. If you're really thinking about that there, you should just buy a bond. Buy gold, buy a bond, buy guns and ammo. Yeah. If that's what you're thinking.
Yeah, gold and brass are always, apocalyptic choices. So, all that to be said, it would be that black swan event, a 45% reduction in residential real estate, which again, 60%, almost 2/3 of the market in residential is subsidized by either the government or has no interest in moving or selling at all whatsoever anyway. So a few years of a tough market wouldn't be a huge deal. The other event would be a mass foreclosure crisis. Let's just say that came on the books and it's something unforeseeable. We have 39 to 45% equity on average that the homeowner has, right? So what we would carry on the upside of that.
That makes sense. So if you have to foreclose them, you have at least dollars there. Your basis is solid. So there's still money there. They're just struggling in their current situation. So that just hypothetically and theoretically makes all the sense in the world.
If we had to foreclose.
You have a cushion. Yeah, you have a cushion in there in the event that it's bad. Your basis is set.
So we buy conservatively for all of those reasons. Again, I bought the foreclosures. I was the foreclosure buyer for so long. I just don't like having to reconvert the capital, or it's a huge drain on team and it's a disruption. We'd rather have long-term 20, 30-year mortgage payments ahead. So those are the worst case scenarios. I mean, again, we've never missed a payment to investors. We've never not returned capital. So our track record's good on that, but it would take a black swan event that would decimate the residential market. And I just don't see it by any of the metrics of 2008 or anything else we're looking at whatsoever.
So with that said, what's the liquidity like for something like that? Is it, 60, 30, 90 day, 120 day lockup period? Because our deals and our investments in the multifamily space, and this is why, just for everyone who's listening, who follows the show, it's nice to have options out there. You're locked up for basically, call it 5 years with us. You married us for 5 years, but you could find debt instruments where it's potentially some options, whether it be Aspen or something of that nature, not to talk about competition here. They're, you
love those
in
guys.
and out. Yeah, exactly. We great people. Ben and company, Mike and co are all awesome. But you can be in and out there. Is that similar to profile with you, where you get some sort of liquidity, kind of coming in and out?
So that's a big question for investors, and they have to answer that. If they're okay with, longer term and they want more upside, we refer them to, guys like Lone Star or other groups that have an upside component. They have an equity component. They have a long-term strategy. Our highest lockup period is 36 months. That's our lengthiest, and that's for 12 to 14% returns. Our shortest lockup period is 6 months. And then after those lockup periods expire, or they're outside of the initial term, they go to a 90-day redemption period. So it's a rolling, period of time. They give us 90 days notice. We'll return capital.
Makes sense. And you don't want to have and that's why I asked, because you don't want a bank run scenario or something like that where you just pull out too quickly. There has to be some sort of a lockout there.
Yeah, and we need to turn the capital on deals, and we focus, depending on where our investors are at and what their period of time and their return profile is, on what deals we buy to support those.
Yeah. Well, industrial, switching gears back to that, industrial is very interesting because it's very straightforward. And also the interesting thing about industrial is that your operation costs are very low. Your ongoing operations, your expense ratio is probably pretty mitigated there. Especially if you've got a good tenant, it's going up incrementally, like a triple net deal where it's like, hey, you get, in the contract there, you get incremental increases here and there. It is so straightforward though. Does that making it straightforward and having it be a little bit more simplistic than multifamily in some senses kind of make it a lot more competitive, if you will? Or, how do you kind of balance that when you do create value on these opportunities and you go through the bidding process?
I think it's different than multifamily for that reason, but the players are also different at different levels. So multifamily has the same thing as far as the layer cake of institutions at one level, mom and pops at the other. We like to play in the in-between for industrial, for the reasons being that when you're playing against like life insurance companies at the high end, 200,000, 300,000
Black
square
Rock.
foot buildings,
Yeah.
and BlackRocks and et cetera. Their yield hurdle, what they need to return on deals, is so low. It's not even worth playing in. It's not, the retail investor would not even be best serviced by us buying those deals and partnering with them on those deals or bringing them in as an LP on those deals. So we skip directly over those. So 200,000, 300,000, while that might look great to jump in a helicopter and fly over this massive compound of 1 million square feet, like the Skechers building in Southern California that is on so many industrial flyers, etc., the reality is to own that is not interesting to us at all. Now, on the flip side, there's the mom and pops and like the multi-tenant industrial, and all those are great. And God bless everybody who wants to play in that space. But it's much of the same, but with lower quality tenants, right? You just have worse balance sheets. You have worse established businesses. You have higher risk on the tenant side. So we really like that in between range. Let's say like 60 to 70,000 square feet up to about 150,000 square feet. We play there very competitively. We know our tenants. We know what we're looking at. We lean into the warehouse side of that equation because the drivers are so different than, let's say, multifamily, right? You're looking at port volumes, right? You're looking at interstate volumes. You're looking at manufacturing, on the border and where those go. So we focus on those markets that have the drivers that we like. So on that side, we like Southern California, the state level of California. There's all kinds of stuff we can talk about, local governments, etc. But Southern California for industrial is a rock star because it has the Port of LA, Port of Long Beach. Any year, that's roughly 40% of U.S. imports. It bumps into northern Mexico. You got Tijuana. You have all kinds of manufacturing that's going on along that southeast border that benefits really all of the southwestern U.S. And then the other market for the same drivers, it's the Texas Triangle. So I know you guys play in Houston and kick butt over there. We like Houston a lot. Dallas, San Antonio, Austin, that neck of the woods for us is the other industrial hub that we like for all the same reasons. Near Mexico, good manufacturing, good distribution to the northern parts of the U.S., good growth, right? Good density. All those reasons we love those two markets.
Makes sense. So would you say that, because obviously those are two focuses, but as you've become wealthier, as you've done well, as you've rode out of the recession, you've made not your first million, but many millions. And now you're kind of looking around, okay, how do I want to structure this? You're a family man, you've got many kids, you've got a beautiful family. Are you kind of switching your philosophy, your strategy? Obviously, you've got a lot of investors who are looking for both, but to the income side of things, because you've kind of bankrolled your millions, and now you're just wanting to have less unpredictability and just a certainty of income kind of coming in. Would you say that's kind of one of the drivers on your end, or is it more just from an investor demand, or have you also kind of seen the value of the fixed income play?
So I like both, candidly. Again, I made my bones. I came up with more of the syndication model, the JV model of set addresses, 123 Main Street type deals, right? So those are very close to my heart, and I know how much opportunity is there. Okay. So where I'm like, as Nick D'Angelo, right? Not Saint Investment Group, but me as an individual, I balance it in two of the buckets we just said. I just threw, 150 grand into our own fund because a deal closed. I didn't really find something I really liked outside of that. It was a smaller dollar figure. So I just throw it in the fund. I do that regularly as an LP into our own fund, right? I don't know. I like the returns. Pretty competitive right now. On the flip side, industrial, I think, is a killer over the next decade. I'm not putting money in industrial today. Our pens are down on industrial for about 18 months. For the reason being, one of the reasons I love multifamily is you can have 200-300 tenants. Industrial, the way we do it, you have one tenant, you have one shot, you have one lease. So being early in industrial is the same as being wrong because you're 5 years into a contract. And if you lease early in industrial at below market, no matter what your basis is, you can do a 10-year play.
Tenants winning all day long, yeah.
So at the end of the day, being early in industrial with one tenant is a huge concern. And I think, again, the drivers for industrial over the next decade are ridiculous, even the next 5 years. But I'm waiting about 6 to 12 months to really start gauging the market and checking temperature. We're close to it. We buy nearly 100% off market. We're very dialed in with the brokers that we love dearly in both those markets. We keep in very close touch, but just none of the deals are interesting, right? You got buyers that want 6 to 7. You got sellers that are still at the 4s, right? So it's just not a lot of movement. The negotiations on leasing are a little sloppy right now. We're not liking how those are shoring up. Still great tenants, still great operators, still great, all those reasons. But so I'm investing personally. I'm putting into fixed income, primarily our own fund and others, competitors that we love. Also, I invest pretty consistently on the multifamily side as an LP, right?
So that's what you like right now.
I do, multifamily would be my third choice because it's such a privileged asset class. It's propped up by the government. Debt's amazing. The drivers, if you're picking the right markets, are fantastic. The U.S. is growing as a first world country, which is rare. I love the U.S. I think, so all those reasons, I still like multifamily, and I still actively cut checks as an LP into multifamily right now. Those are my big three right now.
So how would you structure the ideal portfolio if you had $1 million to place it around right now, starting from scratch, I guess in today's world right now, and I guess maybe just, in a normal condition where there's not, one advantage over another, how would you mix it up? Would you diversify? Would you go all in on something? What would you do?
I'm too old to diversify, Craig. Or excuse me, I'm too old to go all in. I have to diversify. No, I would. That's a great question. For $1 million, I wouldn't be an owner. I'll put it that way. For $1 million, I wouldn't try to do a cute fourplex and house hack and Airbnb. Like, it's just too much management. I got a bunch of kids, like you said. I got companies that I run. I work a lot of hours, so I wouldn't get cute on the ownership side for $1 million. Right? If you had zeros, okay, we have asset management. We have some opportunities for that.
Yeah, you have enough coming. If you got 10 million working for you, not 1 million, okay, well then it's 10x more. Yeah, and you can live very comfortably off that. Yeah,
we exactly. Have a whole team, right? So it's like a bolt-on at that level, like 10 million. But for $1 million, I'm probably putting 40% into fixed income, right, off the bat, because I want to, in this market environment today, I'd probably want a 40% fixed income component. I'd probably put 40% into something with like the 5-year mentality, most likely, industrial if it's in the next year or so. I think some deals will come online. So 40 fixed income, 40 industrial, and I'd probably throw $200,000 immediately at a multifamily operator that I'm really liking. So that's kind of how I'd split it up. I mean, loosey goosey, it'd depend on the deal, but
something with that framework tentatively, in that kind of echelon and threshold.
That's what I've been doing, So it's like I'm liking that model.
You're talking your own book, but you're also giving recommendations based upon what you think is going to perform best. And obviously, you're the expert here, so I don't doubt it. And I think to your point, having the fixed income side of things, the rich really do invest in debt. So to kind of get your hands there is really great, and it's just a means to kind of juice up your cash flow there. With that said, I know you have a lot of opinions, and we got to wrap up here, so I don't keep you forever. We could talk until the sun goes down and then some. But with that said, I know you have some hot takes. So what is some of your hottest real estate takes?
Yeah, I would say massive drivers for inflation 10 plus years out, right? I think plan ahead with your investments. I think plan ahead with your cash on hand. And I think as an investor, you'll come out ahead if you're thinking about inflation as nibbling away like it has been and like I feel like it will. Whether that's a balance of higher rates or whether that's a balance of just a higher inflation rate, we will see what the Federal Reserve does, but we got a decade of inflation ahead, in my opinion. Second is soft landing. I think it'll be drawn out. I think we're going to be dragging this out for a while. I mean, you've heard this too. I've been hearing that we're having a recession or in a recession since 2014, right? And it's been the same headlines, the same stuff over and over. And I think there's still cracks all over the place. It's market dependent is my opinion right now. So that's the third thing, is more investment opportunity than ever, but choosing wisely, because I think most things will be bad. I wouldn't be myself putting anything near office right now. I think there's a lot of shakeout to do there. Too much risk.
There's just no point. There's just no point to accrue that risk, in my opinion, right now. Like, you can still get really nice returns and not, risk it all and thread the needle, I think you're really better off honestly investing in crypto right now, like Bitcoin, than you are in office, frankly. And I'm not in any cryptocurrency at all. I just think that you need to get paid accordingly. The phrase risk adjusted, I think, goes over people's heads way too much. You only see the upside, but it's like, well, you're really missing a little thing called downside, and how your dollars actually get evaporated. So please consider that, folks.
Yeah. And I again, I think there's an insane amount of opportunity in the marketplace, and it's choosing wisely, but I wouldn't be choosing widely. I'd be choosing a very narrow focus. For me, I kind of told you what my three are that I'm looking at. It's fixed income, mortgage backed on that side. I really like U.S. mortgages right now. I really like the residential market. It's, to me, head and shoulders above everything else. If you look at, again, risk adjusted returns, when I'm looking for upside, I'm looking at a 5-year, 10-year play on industrial, particularly industrial warehouses. I really like that play with a lot of the imports and southern manufacturing that we'll see. And then I do like multifamily, but you got to choose the markets really well and work with a local, like, top tier operator. So between those three, kind of like big economic forces that we're seeing, and then between those three market strategies, that's really what I'm leaning into. That's really what we're leaning into at Saint.
Perfect. Nick, you've been a treat. How can people find you, work with you, invest with you? Give us all your information.
Yeah, I geek
your
out
social
on
security too.
Yeah, social security, credit card number. I geek out heavily on the economic side. We spend huge amounts of time. We also give all this away for free. So we're even releasing our economic spreadsheet that shows the exact data points we track. And all that can be found, our free webinars, our free sheets, our free economic trackers can all be found at saintinvestment.com/resources. And it's basically just a huge repository of freebies that we're doing all the work anyway. We'd rather just give it away for free and let other people see.
Excellent. Well, thank you so much for coming on. I have no doubts you'll be a recurring guest on this show, as you just dropped some incredible nuggets here. Thank you so much. I look forward to seeing you soon. For everyone that's listening, I'll see you next week. Peace.